Hello, everyone, and welcome to this week's episode of the Rosa and Rubini podcast, Making Sense of This World. My name is Manas Chavla, and as always, I'm really pleased to be joined by CEO and Head of Research, Brunello Rosa. This week, we're talking about central banks pivoting, but pushing back against premature rate cuts. Brunello, three major central banks of the world have met for their policy meetings last week. Let's sort of summarize a few of these key developments, but let's start across the pond in the United States. What were sort of the key agenda items that came out of the Fed meeting on December 13th?
Okay, so the Fed met in December after skipping the rate hikes of September and November, and actually there was no expectation of any particular move, although the summary of economic projections released in September signaled that the Fed might adopt an additional rate hike this year. Well, this thing did not materialize. Inflation has been falling and is now in a much more comfortable area of around 3%. And the language in the statement reflects that. So the Fed introduces this phrase that if any additional firming is needed, that would be discussed by the FOMC. And the use of the word any means that it's not certain at all that something will happen. They just didn't want to rule out the possibility that any additional firming might be needed in the future. So, but the most interesting bit was the summary of economic projections that was released together with that statement. And that was interesting because they signaled potentially three rate cuts already in 2024. So instead of speaking about further hikes, instead the projections show that there might be rate cuts into next year as market are expected. But instead of this, the Fed was the first of the many central banks that start fighting, so to speak, against market expectation of premature rate cuts, saying, guys, it's true, we have done well, but it's too early to declare victory against inflation. Inflation is now in a much more comfortable position, but we haven't defeated the monster just yet. So be careful in pricing for rate cuts that are not going to happen. So ideally, the Fed would like to keep until June next year. They might be a bit challenging, but potentially around May, April, May, the Fed might need to cut rates or might decide to cut rates anyway.
Yeah. And then the following day, the Monetary Policy Committee of the Bank of England also announced the decision to keep the bank rate unchanged. Were there similar sort of causation logic behind that as well?
Very similar, but with a difference. Bank of England is fighting a much more persistent type of inflation, which is still hovering around 4 to 5%, both core and headline. So it's way too early to even start thinking about rate cuts. Nonetheless, the markets start pricing cuts because they believe that the cumulative effect of bank rate increases, which is around 5%, so 500 basis points in the space of more or less 1 year and a half, will be felt at some point during the next few months. But just to signify how divided the MPC is, there were in fact three MPC members that voted for a rate hike already at this December meeting. They were the usual Jonathan Haskell, Megan Green, and Catherine Mann, who have been on the, say, hawkish side of the MPC for the last few months. So it wasn't exactly a surprise, but actually I think is a good indication of the fact that we really cannot take early rate cuts for granted by the bank. And if that wasn't enough, then Andrew Bailey during a press conference, or let's say press interview, just to be more precise, after the decision, reinforced the message and said, look, it's too early to start thinking about rate cuts. Rates will need to stay at current level for quite a prolonged period of time. So, I'll see you in a few months and we will evaluate the situation at that point.
Yeah. And then also on Thursday, the ECB announced unchanged policy stance. And with updated forecasts, it revised its growth and inflation forecast even lower. So there seems to be sort of, similarities with differences. Tell me more about that.
Yeah, so ECB was more or less on the same page. The market is expecting rate cuts already, somebody already in March. Ideally, the hawks in the governing council would like to get to July, but between these two extremes, a dovish camp and a hawkish camp, probably more centrist um, camp will emerge, and it's possible that the ECB will start cutting rates in April or June. The interesting announcement that the ECB has done regards the PEP, which is the Pandemic Emergency Purchase Program of bonds, that is supposed to run until December 2024 in terms of reinvestment. And so it will be, but there will be a tapering of investment starting from H2 2024, when only 50% of the maturing bonds will be reinvested. And that would signify more or less a 7.5 billion reduction per month on average of the portfolio, which is in itself a slightly hawkish move, because of course, if you don't reinvest, short of start selling directly these bonds, but even not reinvesting tends to put some upward pressure on yields. And so clearly the ECB wants to do that most likely before start cutting rates. Although during the press conference, Christine Lagarde said that there's no, how can I say, correlation between the two. The move about the PEP is about balance sheet normalization, while the primary policy instruments remains the interest rate. And then today, we had on Tuesday, the following week, we had the Bank of Japan. The Bank of Japan was widely expected not to do anything, but provide some indication regarding January, because in January there's a new outlook for inflation and growth. And January was the month in which there was some expectation of the BOJ start lifting some of these negative rates. Yet today's decision is very cautious. Not only nothing happens, but Governor Ueda downplayed any expectation that anything will happen in January. And so, this big change in policy stance that everybody's expecting in the market might need to wait for a little bit longer. So overall, all central banks clearly are more or less, even if in different phases, at a pivotal moment, but they caution market participants not to expect too much in coming months, one way or the other.
Yeah, more or less all of them reiterating as well that, it's way too early to perhaps declare a victory against inflation conclusively, and caveating every kind of positive rate. Very good. Well, this is something we'll continue to watch for weeks, months to come, especially as sort of we expect more volatility on this end in the first half of 2024. As always, Brunello, thank you so much for your time and insight.
Thank you. Until next time.